Hello again, Anthony and Tara. I see that you guys have a couple more questions that you've brought to me, so we're just going to get right to it. So, the first question you have is the change of the business value. So, you guys have been profitable for the past several years, and your last year's net income was $440,000. So, what you're asking is if you were to use a discount rate of 3% above the expected return for the aggressive stocks, what would the value of the business be using the capitalized earnings approach? So, the capitalized earnings approach is a common method for valuing a business. The capitalization of earnings is a method of determining the value of an organization by calculating the worth of its anticipated profits based on current earnings and expected future performance. The formula that we will use to calculate this method will be the net income divided by the discount rate. So, based on the current information that you have provided me, we will now calculate the value of the business. So we have a net income of $440,000, a discount rate of 21%, which is calculated by 18% aggressive stocks plus the 3%, which gives you $440,000 divided by 21%, which gives you $2,095,236.10. Keep in mind that this is a number that is only an estimate of the future performance and can be subject to change. Now, the next question you have is the outright gift of interest. So, in this scenario, we're going to assume that you, Anthony, you're contemplating transferring some of your wealth by making an outright gift of interest in an AATB family limited partnership as follows. So, Tara will get 9%, Nicole will receive 9%, Ryan will receive 9%, Danielle will receive 9%, and Peyton will receive 9% for a total of 45%, which is non-controlling interest. Next, we're going to talk about the transfer of business interest. So, a problem with most successfully closely held businesses is that they can have a large value for transfer tax purposes. There is no established market for the sale of closely held business interest. And also, there is not a large pool of potential buyers who have either the desire to purchase or the expertise to run them successfully. Therefore, the estate of an owner of such a business interest can easily face the prospect of selling the business at a greatly reduced price to pay the estate taxes if proper inter vivos or pre-mortem planning is not completed. Next, we're going to talk about the discounting of the taxable gifts. So first we're going to start with Tara, who is receiving 9%. The value of the share is $107,424. Now we're going to take that $107,424 and times it by 1 minus the discount rate, which allows us to arrive at $69,825.60 after the discount. Now, this entire gift can be transferred tax-free thanks to the annual and spouse exclusions. Next, we're going to talk about Nicole, which is also receiving a 9%. The value of this share is the same at $107,424, and we'll also calculate the discount the same way as we did with Tara to arrive at $69,825.60 after the discount. Now, $15,000 can be transferred tax-free thanks to the annual exclusion, and the other $54,825.60 will be taxable. Now, we're going to go to Ryan, which is also receiving a 9%, and the value of the share will be $107,424, and the discount will be calculated by $107,424 times 1 minus the 35%, which arrives us at $69,825.60 after the discount. Now, $15,000 can be transferred tax-free again with the annual exclusion, and the other $54,825.60 will be taxable. Now, for Danielle, this will be the same. The value of the share will be $107,424, and after the discount, it will be $69,825.60. Once again, the $15,000 can be transferred tax-free due to the annual exclusion, and the other $54,825.60 will be taxable. For Peyton, This will be the same as the other 3 children I have explained. Now to sum this up as totals, the total amount of taxable gifts is calculated as follows. Tara will be 0, and the children will be $54,825.60 each. So when we times that by 4, the total will be $219,306.40. Now we're going to talk about self-canceling installment notes. So a self-canceling installment note, or an SCIN, can be used to decrease the estate while also being able to give the asset to the party you choose. With an SCIN, you sell the item for more than it's worth and are paid back over the years by the buyer. When you die, the remaining payments are then canceled. The thing is that a premium is necessary due to the chance of the payments being canceled. So a premium will be taxed at the long-term capital gains rate instead of ordinary income rates, which also makes this advantageous. The contract must also be done in such a way that the purchase will be paid off prior to the death according to the actuarial tables. Now we're going to talk about the trust for Edmund. The goal of this is to provide for Edmund without having him lose his government assistance. So my recommendation is to establish a supplemental needs trust. This supplemental needs trust would be established and funded by Anthony for the benefit of another individual, being Edmund. This trust will allow Edmund to purchase supplemental items for himself at the discretion of Anthony. His main source of income will still be his government assistance, but this trust will allow Edmund to attain a reasonable standard of living. Next, we're going to talk about the goal for an education fund. So I've been told that you wish to provide for Danielle's education and wish to have the following. You want to avoid taxation, and you want some accessibility to the money. So there's some options that are available that we will explore today, and these options will be the 529 plan and the Section 2503 B and C trusts. So in order to get a good idea of each of these plans and trusts, we're going to go over all of them. So the 529 plan, also referred to as a qualified tuition plan, would be used solely for educational purposes. The maximum contribution of the 529 is $75,000 every 5 years, and the money can be used for tuition, mandatory fees, and room and board. For the 2503B, which is also known as a qualifying minors trust, it is an irrevocable trust where the income is distributed annually. Most often, the distributed funds are placed in a custodial bank account until the trustee distributes it. Now, lastly, we're going to talk about the 2503C, which is a trust that provides for gifts to be considered present interest gifts for minors so that the annual exclusion can be used. The funds from this trust are also distributed to the minor at the age of 21. Overall, my recommendation is to establish a Section 529 plan. This is because the 529 plan offers the ability to increase the amount contributed initially, the earmark for education, tax-free growth for education, and the ability to control distributions. Overall, I feel that this plan best fits what you are looking for. Once again, Anthony and Tara, I'd like to thank you guys again for coming in with all of your questions. If you guys ever have any more, please feel free to reach out, as I always say. And I hope that this has helped you with your questions. And if you have any more, please feel free anytime. Thank you once again.